welcome to Personal Finance FYI, the web program designed to help you make smart financial decisions and to grow your wealth. Today we are discussing 5 tax facts that you should know, beginning with 2 taxes you need to understand, followed by several ways to reduce your tax bill. You might be asking, James, why should I spend the next 5 minutes learning about tax facts? Well, the simple reason is this is about you keeping more of your money and Uncle Sam getting less, and best yet, it's all legal. So number 1 on our list is an understanding of the 2 gotchas when it comes to taxes, and that is the AMT and the net investment high wage earner tax. The AMT is the alternative minimum tax. It is a sneaky tax calculation that runs separately while you're entering your basic info on the 1040, and bam, one line tells you if you owe AMT. The AMT is basically a flat tax calculation that makes sure higher income folks are paying a minimum percentage of tax. The AMT really kicks in for households in the mid 100,000 income range and up. The rules are that each taxpayer must pay the greater of the AMT or the regular tax calculation on page 2 of their 1040. AMT basically eliminates personal exemptions and many itemized deductions such as state and local tax deductions. If you're in a high tax state, you will more than likely get nailed with AMT. Another item that puts people into AMT territory are those employees that get incentive stock options or what are commonly known as ISOs. These can be an AMT nightmare if not properly planned for. Unfortunately, there isn't a lot you can do to avoid AMT other than income shifting if you're on the borderline. This does require a bit of more pre-tax planning to figure it out. The net investment tax or Medicare surtax was rolled out in 2014 to help pay for the Affordable Care Act. What this tax does is tack on an additional 0.9% Medicare tax to ordinary income for those high wage earners and a 3.8% surtax to investment income. If you're single and you make over $200,000 or married and make over $250,000, you will get hit with this tax. When we come back, we'll discuss several ways to reduce your taxable income and hopefully help you avoid the AMT and Medicare surtax. And welcome back. The second tax fact on our list is retirement plans. Outside your itemized deductions, contributing to a workplace retirement plan is the single best thing you can do to lower your tax bill. In 2015, you can put up to $18,000 into a 401k or 403b pre-tax, and if you're over the age of 50, you can add an additional $6,000 to that. On top of this, you may be eligible to contribute to a personal IRA and deduct the contribution. But to be eligible, it is all dependent on your household income. At the end of this segment, I'll show you where to go to download a guide that will share with you all this info. The third item on our tax fact list is flex spending accounts and HSAs. A flex spending account is offered by many employers in their benefits package and lets you put up to $2,500 in pre-tax money into this account to cover out-of-pocket medical expenses throughout the year. Things such as co-pays, over-the-counter medications, eyeglasses, etc. FSAs have generally been a use it or lose it type vehicle, but now many allow you to roll over a certain amount to the following year if you did not spend all the money. An HSA, on the other hand, is a pre-tax healthcare savings account. This is designed to go with a high deductible health insurance plan. With the Affordable Care Act, many employers are having to cover more costs out of pocket to meet their deductibles. And if you're in a designated high deductible plan, you can open an HSA account, and in 2015, you can put $3,350 if you're single or $6,650 for a family into it pre-tax. This money can continue to compound, tax deferred forever. You can even invest it if you like. Number 4 on our list of tax facts to know are dependent care savings accounts and child independent tax credits. The dependent care FSA allows you to put away up to $5,000 per family pre-tax to pay for the care of a minor child under the age of 13 while you and your spouse work. There's also the child independent tax credit that gives you up to $3,000 in tax credits for one child or $6,000 in tax credits for 2 children when you pay for out-of-pocket for child care for a minor under the age of 13. The tax credit in theory is much better than a pre-tax deduction. However, the credit gets reduced fairly quickly even for moderate incomes. The thing to note is that you may be eligible for both. It just requires a little tax planning on your part to make sure you take advantage of one of these if you currently pay for child care. So the 5th and final topic you should know has absolutely nothing to do with your employer's benefits. But it is a common question that I get as a financial planner, and that is the different tax treatment on a rental house versus a second home. The IRS has a rule that if you want to classify a property as a rental so that you can deduct all the expenses on it, you can only personally use the property no more than 14 days a year or 10% of the time it is rented, whichever's less. Any more uses than that, and you begin to lose out on the ability to depreciate the property and deduct all of the expenses. So if you were considering a mountain home or a beach home that you could rent while you weren't using it, just be aware that you need to do some tax planning in advance to see what deductions you would be eligible for. So we covered 4 direct tax facts that you could lower your tax bill as a W-2 employee, and that was the 401k contribution, flex spending account, HSA contribution, and dependent care account contribution. By taking advantage of your employer's benefits, you can knock down your taxable income, which means more money in your pocket and less than Uncle Sam's. If you're interested in learning more about the 2015 tax facts and figures, download a free copy of the guide from the advisory firm website. Until next time, I'm James Daniel, and I will see you on the next Personal Finance FYI.